Okay, boys and girls, we are done with Christmas and coming on New Year's now. We are New Year's Eve 2023 going into 2024. And this is really the best time I've got to look at the macro context for 2024. So why am I doing this? Well, really, it's to sum up and shorten down a lot of the bank reports, a lot of all the noise that you're hearing about what's going to happen in 2024, what might happen, what might not happen, blah, blah, blah. All right. So we're going to go through this. We're going to have a little check on where we are essentially in the business cycle. If you ask 10 people where are we in the business cycle, 10 economists, 10 whoever, you're going to get probably 10 different answers. Okay, so I just want to look at that. Inflation, rates, landing the plane, politics, energy, my thought, the shocks that I see that might come, and the trades, essentially. So the reason, don't forget, this isn't going to be a short video. Okay, we're gonna go through each of these topics, and we're gonna have to make haste here. All right, so let's get into it. All right, looking at the business cycle here. All right, the four phases of a business, of an economic cycle. A lot of people think that this black line is sort of, the S&P 500 in a way, and it's not. It's the GDP of country, global GDP, so on and so forth. All right, and I think, where it's always well, before I get on to where I think we are, it's always difficult to kind of plot where we are here, but I think we are in somewhere in this peak zone here, outperformance, financial, energy, and materials. I think we're kind of maybe on the cusp here of either coming into peak or we're kind of, starting on the downslope, but we're somewhere around here. And the reason why I say that is because essentially when I try to kind of pin my thinking to think as to what's happening, I kind of look to see what specific markets are doing what over kind of, a month or two or 3 or 4 month period, right? And so we've seen that these equity markets are way out in front of their skis right now, way out in front of their skis, as in we are pricing in certainly 3 cuts, I think, in the first half of the year, if not 4 for 2024. And so if that's the case, that's fine and all. And the whole market's thinking, right, well, we get to the first cut and the market's just going to tank completely. And I think, from talking to some people about this, I think people are saying, well, I'm going to fade that and I'm probably going to buy into dips into that and so on and so forth. But I think, if you do the inverse of what the market is and you're trying to fade the market, I think the faders will be fading them. Faders will be fading the faders, if you like. So I think it's just plain and simple. If we come into the first cut, I think the market's going to tank, and then it might have a nice little bid off of that. Who knows? But I'm not holding. I'm not going to hold equity positions like buy something like on January 4th or 2nd, and that's not kind of. I'm not taking long-term equity positions on the indices on this. But anyway, personally, I think we're front running the economic contraction here. Okay, we're front running that. No, we didn't get the recession and the contraction in 2023, and a lot of people thought we would. And you did see a little bit of that in Q1, but I think it was just a bit too early. But now you're seeing, and the bonds were selling down as well. The yields rising and rising, the real yield rising and rising. Gold under a lot of pressure. But now I think Bill Ackman being out of his shorts kind of just wrapped it up in a bow. We were looking at that trade on our charts as well, had similar levels to Bill Ackman. It was pretty obvious if you look at the charts, and I've showed it before, but look, people have been buying the bonds and people have been buying the stocks. Okay, so I think we're essentially front running. Within Q1 or Q2, we're going to hit this economic contraction sort of territory. And what does that mean? Sort of GDP contraction, tightening in credit, all that sort of stuff. Okay, that's where I think we are in this cycle. Okay, so where are we off to next? Inflation. All right, let's zoom out and get down to inflation. All right, when you talk about inflation, the big discussion really is 1970s. We're going to have this massive double header on inflation. Now, I think in looking into this, I just don't think it as easy as overlaying the 1970s analog onto this, with our own inflation here. So yeah, I don't really see it being as simple as overlaying the inflation here. So if we just kind of jump into sort of where we are now and looking to the end of 2024. Yeah, so where we are now, and then looking forward into 2024, we do see inflation dissipate, and this is how it's played so far from 2015. You're seeing 2020s in blue here. 2020 and our modern inflation in blue, and the 1970s analog, which started in 1967 in orange. Okay, and you see this overlay, right? And so we're looking forward to dissipation as we have down through 2023 and continuation in 2024. But this chart only shows us half of the picture. So from Apollo research, the Apollo Academy, these guys, this is the analog of the 1974 to 1982 inflation. And so you see where we are here crossing into 2024. Yes, inflation will continue to go down. CPIs will continue to go down. And then you're seeing this almighty mid 2024 where we just have a massive respike, and in the first kind of what will be kind of coming into the election of the new president, or certainly it'll be the polling, and the elections will happen around when this respike in inflation should happen, and then we just continue up and up and up. Okay, so this is like a much broader look at inflation overlaid from the 1974 to 1982 analog. All right, I'll come back to why I think we might get this inflation spike here, and it's pretty sensational. But basically, I think with Trump and Biden set to go head to head on this election, I could just see this being probably one of the most fractious type of U.S. elections that we've had in modern times coming up here, and there'll be lots of reasons for that I'll get into. But this is the inflation. Just wanted to pay attention where the market, I don't think the market is trading or gives a damn about any of this at the moment. I mean, but for now, inflation is set to keep going down. All right, that's all we can take off of this. All right, but just be aware that 2025 could be pretty crazy. So nothing to worry about today. All right, something also to look at as that you have to remember about the 1970s inflation spike, 74 to 82 especially, was that oil quadrupled over that time. Okay, now also I don't think we're going to get oil quadrupling from wherever we are on oil right now, 70s, right? So are we in 70s on oil? Let's just have a little quick look here, and 71.33s on WTI. Okay, so I don't think we're going to get a quadrupling under any circumstances. I just can't see that happening at this time. Back then OPEC was kind of set up in a slightly different way, and also the banks back in the 70s had multiple remits. The central banks have multiple remits around the world for why they were in existence and what was their job. Now the focus is much more on controlling inflation and price stability and jobs, basically. All right. Whereas in the 70s they had a much more disparate portfolio of things to do. Okay, so I think this is why we're not going to get massive inflation spike copying exactly what happened in the 70s. One thing I did want to put this chart somewhere else, but essentially one thing to take note of here, guys, is that as we then now get into talking about equities and looking back from what we just looked at there, looking back to it, the expansionary, contractionary peak, where are we in the business cycle? What you're looking at here are months since the start of a recession. So we're looking at recessions kicking in 1970, 1980, 90s, 2001, 2008, 2020. Okay. What you're seeing in red is the accumulated household savings. Now, what you can see on every other occasion, 1970 through 2008, all right, is that savings increased throughout that period. Okay. You see all these charts going up and to the right, how you want to see all charts go, essentially, that you're invested in. But what's happening here in the US is that people are spending everything they got, keep going. All right. So I think this is why we are not going to see the expansion. All right. That some people, I don't see why you would be looking for expansion to happen here. But if we kind of go back to our business cycle, right? If you see expansion happening and consumer demand rising, against those sort of savings pictures, well, basically, I just don't see that happening. Okay. I don't see that happening. I see we're coming into contraction. So we're somewhere probably around here, I would imagine. Does that mean equities are going to stop going up? No, I think the next pullback on equities will be bought. But I think this is really important to know where we are and utilizing this household savings in America to figure that one out. Okay, so look at these charts. Looking down here as well, we have really interesting charts as well from Apollo. The interest rate on credit card debt topping 20%, topping the top 20%, and it's still rising. Okay, it's still rising. This is the debt going back all the way to 1995. All right, and so you see here the Fed's starting to raise rates. It's just catapulted this chart to the upside here. It's just absolutely crazy. So I was giving out to some people on Twitter for posting charts that were not that accurate and looked like they were a little bit juiced and sensational. So but this is from the Federal Reserve Board here. So this is a true chart. Just get us up here to keep me good. All right. So credit card transitions to serious delinquencies. So this is by separated by age. Each color is a different age group here. But you're seeing the 18 to 29s getting absolutely slammed here on the delinquency rates, rising close on 10% here. Okay, so that is big news. Now, if you look to the left here, coming across these charts, 2020 delinquency rates obviously kind of ran into that high here. So we were not. It's not like we just came into came into the COVID with these rates kind of flattening or normalizing. We came into COVID with there being elevated delinquency rates, and then obviously the reason why this chart goes down and to the right at this point is because we have the Fed just stepping in and putting a couple of $100 bills in everyone's pocket, and so now we're coming out of there. Student loans are kicking in again, so this is probably going to rise above the 2019 levels, and looking back to 2008 2009 levels, you're looking at 14% delinquency rates there on the credit card. This is serious. Like, this is serious. So, but look, you got to trade and just go with what's in front of you at any given time. And so, look, are we going to accelerate here? Well, the Fed have been raising the rates. Consumer rates are not lower, and then the long and variable lags will certainly kick in. All right, because of that. So that will eat into these credit conditions. All right, so that's really kind of all I want to do on inflation. All right. Okay. Next topic. Moving on. Rates landing the plane. All right, here we go. Rates landing the plane. So I've got a couple of charts here. So the market sees about 6 cuts for 2024. 3 cuts are priced in first half of the year. Just a little note here in black from me. If they're too easy with monetary policy, inflation could come roaring back. But if they keep the policy too tight, it could trigger a recession. So I think with the long and variable lags I think they're starting to kick in, to be honest, from some of the charts we were just looking at there on delinquency rates. I don't think the steering wheel is that tightly attached, really, between the Fed and the market. When it comes to feeding policy decisions into the pipeline, the futures markets and the markets will price it in right away. But I'm more talking about the economy here, and which will then come back to the markets in the shape of consumer demand, credit conditions, and all that sort of stuff. This is kind of boring, I think this is a note from Morgan Stanley. The decline of inflation in inflation in 24 will be much more gradual in 23. Yeah, we were talking about this. It's like kind of like running a marathon time. If you like run a 4-hour marathon, it's quite easy for you to then get down to running a 3.5-hour marathon. But then if you go the next year and you want to run a 3-hour 15-minute marathon, those 15 minutes you will not be able to jump down in 15 minutes, improve that 15 minutes in time as easily as you were able to cut 30 minutes in your time. It's the closer you get to those smaller incremental gains, the harder it is to hit those targets. And so what you're seeing here is essentially, where we have been on inflation, 2% target, still quite down there. And you're thinking, wow, we've come down so far so fast in the last kind of 12 months. So why couldn't we just kind of get there in the next 2 quarters? Well, I don't know if we're going to get 2% in the next 2 quarters, but it's probably maybe Q3 we get there. Maybe Q3. The Fed, though, to caveat that, isn't seeing us getting there until 2025. Just to kind of put that out there. Okay, we'll move on. More charts. I'll get onto politics now in a second, but I do have a couple of these little charts here. All right, just want to kind of remind people as we kind of talk about rates landing the plane, I just want to kind of remind people about some of these charts here. Okay, so NFPs. Look at these NFPs. All right, so this is the NFP chart from 2021 to where we are now, essentially. And you're seeing that adding jobs is not what's going on here. That's not what's going on here. We are steady decrease to the downside here and set to go on further. So then we're just going to continue this trajectory. But you're saying, Tim, well, we've gone up and up and up in equities over the last 12 months. In fact, I forgot to mention, well, this is what the forecast was for 2023 from a lot of these banks. Barclays down 4%, the spread to Wells Fargo being up 12%. Well, well done, Wells. We ended 26% up. Actually, probably a bit more, right? So, as we then kind of go to look at what was happening in NFP during that time, okay, this is a really good example of, the market are not the economy and the economy is not the markets. Okay, the markets are pricing in, 30, 60, 90, 180 days forward information. They're front running everything all the time. All right. I thought there was a really interesting note from this paper. I will post a link to this paper from Apollo Academy, but I just thought this was quite an interesting note. The US economy economy has defied expectations once again, despite predictions of a sharp slowdown in 2023, even a hard landing. Both consumer spending and corporate earnings stayed strong despite monetary conditions. Inflation has been moderating without the typical coincident reversals in the labor market. Yeah, I don't know about that now. Well, they're saying not typical, underscoring the Fed pivot in the last FOMC meeting where they've gone to more dovish stance and the markets have rallied. And a growing number of prognosticators are voicing confidence that a soft landing may be in the offing. Fine, you can have a soft landing, but it doesn't mean you're going to escape contraction in consumer spending. Now, when I'm looking at this business cycle and we're into contraction, again, you got to separate out that the market will price in and price out stuff very quickly. So the market, if we have a hell of a pullback come in, don't be expecting that to be just the start of it. We could have like an almighty pullback on a geopolitical risk or a really bad NFP or really bad Q1 earnings season, and then the market will just price in that low and will rally out of there. So the lows never look like the lows and the highs never look like the highs. Okay, so you got to make that bold step, and effectively you got to forget about all of this stuff when you're trying to make a trade. It was certainly in the day trading environment and sort of medium term trading environment. All right, just some other charts I wanted to have a look at here. When we're talking about geopolitical picture and the US dominance, this I thought was an incredibly interesting set of charts here, because this kind of looks at the bulging amount of debt payments that the US has to pay to the people who are buying its bonds, its treasury. And you're seeing here, we're now, I don't know, 1.8 gazillion trillion here, almost $2 billion in 2023 is the nut that the US has to pay the people who are buying its bonds. So basically, if you want to borrow money in the international markets, you issue a bond and they're paying higher and higher interest rate servicing costs to these lenders, essentially. What you're seeing, that's all been fine and well. And I know a lot of people are going to say, well, yeah, but they're never going to default on that because it doesn't even matter because they just print more money and, get Janet Yellen to just print more out of the treasury. Fine. Here. Okay. But this is the chart I really wanted to look at here, is that the trend in foreign ownership of these US bonds is down. Now, foreign holding of these bonds is down. All right. So here you have COVID coming in, and from there, it's actually quite a distinct disinterest from foreign buyers of US debt. Now, obviously, in 2008 and 9, well, it was great. It was all the rage to get on the risk-free rate, 10 years, treasuries. It was a flight to safety. Okay, for sure. And certainly in and around the dot-com crash, essentially coming in here, and just the wash of that, people getting in on the bonds, right? And then this, I don't need to talk about that much more. But again, here's the net foreign purchases for treasury bonds and notes. So the bonds being the longer duration, the notes being the shorter duration. And you're seeing here private interest, while through 2021 has been massive, it's now falling off a cliff. Now, for me, it doesn't really make sense because, well, it does make sense in that if people just crowded in on the longs on the 10 years and across this curve, the almost 5% yields, and now they're done. Now they don't want to buy anymore. They've assigned that trade on the risk-free rate. I mean, fine. Okay. So just noting this, okay, and this might continue to drop for global interest on these US bonds. Want to move on because we have a lot to cover here. Okay, so we'll look at politics. Okay, now this was from The Economist. Essentially, there's a great article that I'll post a link to for this video from The Economist, where what is going to happen is in 2024, this will be the biggest election year in the history of the planet. You're seeing 4 billion people going to the polls across this planet. Never happened before. 76 countries will have votes. As of The Economist's view, 43 of these will be fair and free elections. 27 are in the EU. The bulk of them actually being in Asia. And then here's a little note from me. So essentially, if you're going to stop for a second to think about this level of elections and change going on around the world is unprecedented now and it will be in 2024. The level of change and what that can do to markets. Well, we've seen what elections can do to markets. Remembering back to when Trump was like, we were in the run up to his election, the world and after his election, Europe, there was the kind of fear of the far right, Christine Le Pen, Geert Wilders, who it now is actually voted in. There was kind of this specter of these extreme far right figures getting voted in Europe and all around the world. And it didn't happen at that time. But what's different now is that essentially essentially, a lot of these governments have been coasting on the hopes, dreams, and goodwills of those who are good, faithful Democrats across. And I'm not when I'm saying Democrats or Republicans or kind of right parties. I'm not talking about just the US. I'm talking about globally here. Okay, what we're seeing is that actually over the last couple of years, these Democratic parties have become quite right wing in a way in enforcing and stuffing kind of ideas and policies down people's throats. Now, if you kind of want to say that, let's just take the US as an example, that Trump is, or this kind of, if you want to say that Democrats are, democracy as an idea is just thriving all around the world. Well, you tell me where. You tell me where, the Democratic left parties are doing fantastic right now. And we all know what it is. Its immigration policies are really poor in a lot of these countries. I'm in Ireland, I'm Irish. We're seeing a disastrous approach to immigration is now reaping really significant bad effects on our country here. Is it a case where we don't want immigrants to come in and more immigration? No, that's not what I'm saying. I'm saying that the country is not deploying a good enough plan to do this in an effective manner. And we're seeing this not only in Ireland, we're seeing this in the UK, we're seeing this in the US, we're seeing this all around the world. You're seeing it in Asia, you're seeing it in the Middle East, seeing it, Russia. So this year coming is going to be massive because people are going to the polls in the greatest number in all of history, and I think there's going to be a lot of incumbent parties that are turfed out on their ass this year, and that is going to bring a huge amount of instability to the market, not only to the markets but obviously to those countries as a first order consequence, and then as a second and third order consequence, the markets will price that in immediately. So I don't think we're going to have any let up and be resting at all this year when it comes to trading, because we have a lot of these G7 countries are holding elections, and we're going to have to be trading on the back of some of these. So get your Weetabix in and get the energy drinks ready. All right, so that's the main comment on politics. Then where else will we go to? All right, energy. So energy is kind of simple. All right, now you're probably all thinking, well, energy is never simple, Tim, but I want to go and talk about this a little bit. Okay, so where have we been to get to where we are now with oil? Eventually, well, we were looking to continue to the upside, and then it kind of came out at the start of this year, and then it started coming out that Russia actually they were producing a lot more than we thought, and we started to dip on oil. And then essentially geopolitical risks rose, and the tightness of underinvestment in 2020, 21, and 22 started to kick in, and we sort of picked up the bid again. Lots of OPEC involuntary cuts coming through. We had two sort of surprise, if you like, 1 million barrel a day cuts come through. We rallied up on that, and then we had a couple of gap ups, and then we were just not able to hold above those gaps, or once we closed the gaps, the market was not able to hold and came down into good buying area. We came back up. So it's been a bit of a washing machine, to be honest. I mean, if we just look at kind of oil on the monthly bars, going back to, and just let me hide some of these drawings to keep it tidy. There we go. And then we'll just normalize the chart a little bit. Where is December 22? So we are pretty much here. Okay. So we're pretty much, these are non-back adjusted, right? So we pretty much, let me get this automatically. There we go. So where were we in January this year? We're right here. Where are we now? Not much further away from that, essentially. So we're about 3.5% from where we were in January. All right. Sorry, hold on a second. January. Yeah. Here, there. Yeah, we're super close. So really just what you do about nothing. Okay. Now what could happen this year on oil? Well, I think we've seen what these Houthi attacks can do. We had the invasion, to finish off on what we had in 23, and we all know is that Hamas attacked Israel. We saw a bid come into oil. We went into 92s on WTI. We were not able to hold it. We were too priced in there for what was not immediately going to be a supply risk to oil. The big picture would have been a fourth order consequence where Iran would get involved, and then there would be impact on the Straits of Hormuz, the Red Sea, Yemeni Houthi attacks. These were all fourth and fifth order consequences of the Hamas attack on Israel. Okay, so I thought we were way too overpriced. We sold sold that as a group. We sold those highs as a group, and we did very well out of that. There were also some seasonal trades mixed in with that, which it just worked out absolutely perfectly for us. And we're going to continue to trade off of some of the seasonals, which we're still in now, looking for longs, looking for the market to go up in Q1 into Q2. But the big picture here is that there is going to be a sustained risk to oil price from what's happening, what we've seen the tip of happening in the Red Sea, where shipping supplies stop going through the Red Sea. They're going around Africa. Now we're seeing some flows coming back into the Red Sea, and we're coming off in oil because of this over the last probably 2 or 3 trading days, while I've been kind of nursing a turkey hangover and not really looking at the market. But nonetheless, we're coming off because we do have a resumption of traffic in the Red Sea. What was really quite out of the blue was that the Houthis attacked ships coming out of the largest Indian refinery facility, which actually isn't, well, it's quite far away from Yemen, but it's really a clear shot across the ocean to that refinery. But they were attacking these ships coming out of that refinery and heading towards the Red Sea. We see further escalation of this. You don't want to be selling oil. If we see a firm dissipation of Houthi risk, then fine. You probably do want to be selling a little bit of oil on that news, or over that general de-risking. If you've read some of the statements from the Houthi rebels, these guys are promising to put oil at $1,000 a barrel. $1,000 a barrel. They are talking about hitting all the major infrastructures and shipping route in the Middle East. All right, and they want to go for it. And you know what? The biggest Houthi attack that I've ever traded was where they hit refinery facilities with drones in Saudi Arabia, and we had that happened I think on a Saturday, and on the Sunday night reopen we gapped up 15% in oil, and it was crazy. So these guys know how to do it. Now, are they going to get oil to $1,000 a barrel? Absolutely not. But are we open to upside price shocks? Absolutely. So there's going to be a lot of talking about demand destruction, which I think is for the people who are smoking crack looking for rate cuts in 2022. I think they're talking about demand destruction. Well, that's their new bag. And the other thing really that kind of plagues in and around oil at the moment is that the North American producers, frackers and drillers are now back at it. And we have North American oil production back at I think about 13.2 million barrels a day, which puts them top of the pops in terms of global production. Okay, so if you kind of look back at 2014 highs in oil, you see kind of here, this is kind of the COVID. We just go back here to 2014 highs. So let's see, where are we here time wise? Some of these are kind of wrong right now. But essentially there was a ramp up in US oil production because of the fracking revolution. It kind of started in 2008 and ran into 2014, and then it just became too much production, where Obama was issuing export licenses for US crude, and we just peeled off. And so we kind of effectively completely just dissipated on price. Back adjusted here. What's important about that is that we're back at that level of production now for US oil. And so we really need to be careful about thinking that oil can, for example, quadruple or get into an all-time high. So if we don't have these, or black swan events hitting oil, to bring us to the upside, there is going to be downside pressure on oil through 2024 because the producers are back at these all-time high levels in terms of production. What you're not seeing though is that the rig count going up, and this is because of something called DUCs, essentially drilled but uncompleted, DUC, drilling uncompleted, drilled but uncompleted, all right, DUCs. So a lot of these oil companies will drill several holes and then cap them and then come back to complete them. So what's happening is US oil, without a rising rig count, has managed to raise production, and that's because they're going back to all these previously drilled holes, completing them, and then extracting the oil. Okay, and so the rig counts are not a good indicator for these type of things, as is illustrated right now at the moment. All right, that's energy. We really want to keep moving on here because I don't want people to be too long. So right now we're moving into the meat of it all. Right, my thoughts of what's going to be happening this year. Okay, what do I think is going to happen? All right, so what I think is the bonds will continue to go up, the yields will continue to get crushed, and you're going to see then gold just enjoy that upside, and we could see a really good sustained breakout. Now, my last weekly look ahead of the year, I was looking for gold to pull back into about 2017s, I think, and we just didn't get it. We just didn't get it. So I think my look ahead was somewhere in around here, and we just didn't get that pullback. We just didn't get the pullback down into the 17s into here. We just actually had a shallow bottom, and then we're breaking out, right? So these are monthly bars now on gold, right? So you're really kind of hitting over these tops here, and I think we can continue higher. I would be pulling. I would be buying any dips you're getting on gold this year. The deeper, the better. That's one thing. Then going back to the whiteboard. Yeah, but as I said, I think a couple of weeks before my last weekly look ahead, you're going to need to see the confluence of, you're essentially trading the bonds, the 10-year bonds when you're trading gold, essentially at this time, right? So you're going to need to see the dollar have a rally and then top out, and that's gonna be. But if you can time that with a pullback, an upside pullback, we move it to the upside and then we pull back on US 10-year, for example. If you can time those two things with dollar and 10-year bonds, then I think you're into a really, really nice gold trade. So I was just kind of trying to get a bit too smart and a bit too selective with a long entry on gold. But hey, I'd rather get a good entry than be chasing it at a place where I'm psychologically kind of compromised as to my confidence in the trade. All right, the long and variable lags, we haven't really seen them bite at all. I think 2024 is going to be the year of long and variable lags, LVLs. I think we're just going to shorten this up to LVLs. I don't want to keep saying this. It's going to affect the credit conditions. We're already seeing that from some of the charts I showed you there on the credit card delinquencies. The same sort of picture exists for auto loans, all this consumer sort of credit stuff. So I think the bite of these variable lags is going to cause a contraction. Is it going to cause a recession? I don't know if it's going to cause a recession, which is going to be 2 quarters of GDP contraction. Maybe, who knows? But the thing is, that's not tradable information. Whether I know as a fact, as gospel, whether it is or is not going to be so, it's untradeable. Even if I knew for a fact that the next 2 quarters of GDP in the US were going to be contracting, and therefore it's a technical recession, it doesn't matter. It doesn't matter, because it's like, what is the trade? What is the trade? Well, you have to, with very tight risk as how we trade, you need to see where your desired market is that you want to trade, at that day. Where is support? Where is resistance? Where are buyers giving up? Where are sellers giving up? Where are sellers puking? Where are buyers puking? Okay, energy. Geopolitical risks will remain or elevate a potential black swan event. All right. I think things could easily kick up. What's happening again? What in the Red Sea? What's happening is that a lot of the warfare sort of people that I listen to, just a lot of the stuff I listen to, all right, about the Israeli-Palestinian conflict, is that the Israelis are losing, and they have now entered into a phase of warfare that they are vastly not prepared for, which is, number one, conflict in a desolated area with a tunnel network underneath it. Now, listening to specialists who have been in those situations, and these are US people, these are British military strategists, they say that is the hardest environment to fight an enemy in, where there's a tunnel network. Just that alone. Vietnam, the Viet Cong had a massive tunnel network, and the US did not win that war. They basically came out of it. They might, they just had to get out of there. They couldn't hack it. If you're in an area that's desolated, rubble, that's also incredibly hard. Now, Gaza is the war front for Israel, the IDF, and it's both of these things. And it's going to be really hard for them to make gains. They have had a release of a total of 6 hostages out of 150 or something. They're not winning. They're bombing the shit out of it. They're killing children. They're not winning. So global support is now extremely diminished for Israel, and it is looking highly likely now that Netanyahu will be facing International Crimes Tribunal in The Hague. I cannot see that not happening. And you're seeing already some of his cabinet ministers are not standing with him when it comes to conferences, when it comes to his policy decisions lately. And good. I think the guy should burn. I think he should burn slowly. Stick him in a slow roaster for 6 hours, man. Tell you what. So, yeah, that's that. Placing money in the US Treasuries will remain the careful and astute trade. So the risk-free rate, looking at that trade, we look at treasury yields here, right? You're looking at 3-month bills pay you 5.3%. 6-month bills paying you 5.25. 12 months paying you 4.7. I mean, come on. This is nice. 10 years now down to 3.88%. I mean, for you to just take the 12-month bill here, we're going to get paid out on that one. Well, the thing here that we should be looking at, and this is the difference between the S&P 500 earnings yield 10 10-year treasury yield, and it's at zero, meaning that this is at par. So the forward earnings potential of the S&P 500 companies by comparison to the yield you're going to get from the US Treasury is back to zero. Okay, back to zero. So that means that effectively you're better off going with the US 10-year bond at the risk-free rate than risking your ass buying equities at these uber elevated prices. And this is the source from Bloomberg, this chart, and it is in the link for this Apollo Academy 2024 look ahead that I'm going to post with this video. Okay, so let's just get down to it here. So here are the potential shocks. I think commercial real estate remains a potential, not black swan event, but major shock to the US economy. I think with the rollover on the rates of the specific commercial real estate loan books, they're going to be rolling now onto these higher interest rates for those loans, and they'll be kicking in. So you're going to see probably much more of a handing the keys back to these banks in the US and indeed around the world for commercial real estate. And so what impact is that going to have on the stock market? I think a negative one, which will quickly be bought. So you're probably going to be seeing dips in KRE index, which is the US banking small banks index. I think escalated shipping issues really need to be respected, because while the Red Sea poses more of an inflationary risk for Europe, I think if you see a greater instability of shipping in that whole area, you could have a major problem on your hands. But looking at that, you might have a shipping issue in the Red Sea. Fine, that will mainly impact inflation in Europe. That's for the problem for delivery through the Red Sea to Europe. Okay, for US deliveries, East Coast deliveries, they will be impacted mildly by that too. But if you look at US West Coast deliveries, that would be maybe trans-Pacific ocean crossings. You need to realize China is now eyeing up to go into Taiwan and take it back. So if you're not familiar with the Taiwanese-Chinese situation, Taiwan got independence from China in about 1948-49. Its economy has been booming since 1981, and the chips manufacturing for about 90% of the world's microprocessors goes on in Taiwan. Now, Warren Buffett had invested in the largest, I think it's TSMC, the largest chips manufacturer in Taiwan. He's now out of that investment. He doesn't like the geopolitical risk that it brings at the moment, but this could impact Nvidia stock big time. If China go in to Taiwan, or that risk starts to get priced in, warships going in, boots on the ground, fighter jets in the air, that's going to be a major shock to technology indices, NASDAQ, and the big seven, which have propped up these equities markets for the past 6 to 12 months. It's going to be a huge shock, and that could be the black swan event that could really cause a major pullback in global equities. All right, a major global shock if China go in there, because if China go in there, you're going to have a disruption to the microprocessor production. If Nvidia cannot then get supply, they don't have a business, and therefore they're going to take a cut in their earnings and on that current quarter, and maybe the next quarter and the next quarter. So that's got to be priced in immediately. All these EV car manufacturers, yes, Tesla, Baidu, or what, not Baidu, all these EV manufacturers are going to get any car manufacturer is going to get completely walloped by this sort of a risk. Okay, so we have a bit of a choke point. Now, don't talk to me about how North America's got this CHIPS Act and it's onshoring now a whole lot of chips production. That won't matter. Yes, there is a global focus on microprocessors out of Taiwan. Yes, the US is doing some great work to take us away from that choke point. It's not fully there. Take away the risk of what would happen if China went to Taiwan. Anyway, I don't want to go on too much about it. Here's the big one, right? And this is the big one. We've got to take some beer for this one. So we've seen state of Maine looking to block Trump. I think they've cycled back from that. Seen the state of Colorado blocking Trump from the electorate. You've seen other states in sympathy block Biden from the electorate. So there's all this tit for tat going on in North America right now. Okay, and we're coming up for elections in November in the US. All right, for the presidential elections. I mean, it's obvious to the entire world that they're trying to throw the book at Trump out of the elections to just ban him from not running. And it's sort of like, what won't kill you just makes you stronger, and that's what seems to be what's happening with Trump, is that the more they try and keep him out and away from this election, the stronger he gets. No, I don't want people to be like, oh man, you're for Trump or you're for Biden or whatever. I don't give a shit. I don't care. I don't care. I just look to make money out of these events. All right. Yes, I have a Trump Make America Great again hat. That doesn't mean I'm not voting in America. It doesn't mean that I'm a Trump supporter or or if I had a different hat, I'm a Biden supporter. I think most traders would agree that Trump was fantastic for traders. We got some great volatility, some amazing trading events, and that's why I have that hat. All right. Now, do I agree with some of his policies? You know what? I don't even know what some of his policies are. Okay. So that's where that is. All I know is what I can see is that the Democrats are trying to keep this guy out, and it's looking more and more and more likely he will get in. Okay. So what do you think is going to happen when we come to January, or the night of the polls, and they all come back, and it comes in that it's Biden? Well, with Biden's polling dropping like lead turd over the last 12 months, that's going to be kind of hard to believe, and the Democrats won't let anyone else decent have a go. Kennedy, okay, maybe Kennedy. I thought he actually was pushed out, but he's back in. I think Kennedy could do it, but if it's between Biden and Trump doesn't get in, forget about January 6th last year, or the last time. This is going to be way worse, and I think you're going to have massive US unrest where there's I saw a trailer for a film called Civil War coming out. It looks kind of good, but I as soon as I saw that, I was like, well, yeah, that would kind of make sense if Trump doesn't get in, because there is just so much groundswell of support for him, and he is Teflon now. He's Teflon. He can't do anything wrong. And I think the people who rest on the Trump side of the fence are not going to lie down, and you saw that in the January 6th storming of the Capitol, and I think you're going to see just a much bigger and a much worse version of that. So US unrest 2025 is what I'm saying. So just keep that in the back of your mind as we get closer and closer to November. All right, it's when we look to when they look to elect the president. All right, here we go. Here's the trades. Here we go. You ready? Here are the trades. This is not investment or trading advice. This is what I personally am going to be doing. Okay, long the bonds. I've talked about this with Jason. I just see these yields getting crushed now. The reason why we would be going up in the bonds is because I think that things are getting a little too frothy on equities, and people are just piling in essentially to these risk-free rates, really high yields, and they're going, yeah, fine, 3.5% or 3.8% on the 10-year. Well, 4.86% on the 12-month. Yeah, I'll take that, and I don't want to risk, trying to sweat my portfolio, trying to make 5 or 6 or 7% in the Nasdaq or the S&P return. I think people will go, hell yeah, I'll take a bit of bonds yield, or 4.86% for 12 months. Great. So bonds long. I think gold by the pullback, the real yield falls with bonds going up. Again, I'm going to always be looking to get into these. I look at these markets every day, all day, and that's my job. And people who trade in Doug Capital, it's their job, and they're looking at the markets every day, and they know what's going on. We have news services that give us real-time information faster than Bloomberg get it, faster than CNBC get it, faster than BBC or Reuters get it. We pay big money for these sort of services. Get out to Financial Juice. And what I'm trying to get at here is that don't kind of blindly, I think, be going in. Well, I wouldn't. What I'm saying is I wouldn't be going in blindly, just looking at a gold ETF, going, hey, I'll buy that there, and I don't care about what the risk is to the downside. You can't do that in a margin trading account, in a futures account. You can't do that. You need to have a well-known risk allocation to each trade, and you need to know, do your entries line up with where your risk is going to be on a trade? All right, I won't go on about that. I'll save that for the live Discord. Q1, Q2, long oil. I think the selling has been a little bit, or is going to get a little bit overcooked from the dissipation of the Red Sea risk that was in there. There has definitely been a Red Sea risk, and I think there will continue to be a Red Sea risk until Israel down and see light, or else Netanyahu is put out. One of those two things. But until then, the Red Sea risk remains these real supply risks, not just a spat between Gaza and Israel. These real supply risks driven by the Houthis rhetoric, driven by what Iran are going to do. They're the real risk factors, and I think until they're dissipated, the price sensitivities to the upside. What else? Don't trust the highs in equities after Q1. Yeah, so that's pretty much once we get into the first rate cuts, or hearing about the rate cuts or not. I think the market will settle after Q1, and it'll become a little bit more obvious. But essentially, I think if we start running into highs in MQ 234. Sorry, 5234. I think I might want to be seller on those pops. It all depends though. It all completely depends. And so I'll be keeping you guys updated with the weekly look aheads on that. My portfolio trades long energy, boys and girls, focusing on nat gas ETFs and oil upstream and downstream. What that means is exploration and production companies and pipelines. Now, this is a pain trade, right? Because you don't want to just be super allocated at one price. You want to kind of spread your price risk around a bit on these companies. But I'm in Petrobras, BP, Exxon, Chevron, Occidental. PAA is got a yield, an annual dividend yield of 7.06%. That is better than the risk-free rate. FYI, you could be long bond ETFs is one way to get some of this bond appreciation if you're not buying futures. And then looking at the rare earth minerals. So here's a couple of ETFs on REMX. I'll just kind of quickly pull that into view if I can find it here. Oh yeah, here we are. I'll just do a quick little analysis on this. Yeah, so here is REMX, the VanEck rare earth metals. So I like this. It's kind of giving up support in this. Oh, sorry, I'm getting yields here on this. There we go. It's given up supports around 73s over the last kind of, I would say, well, back in August. I think a nice support baseline here would be like these. But it's looking like it's already wanting to go back up here, boys and girls. So do keep an eye out for this. I think we could easily get back to 100s on this over the course of the year. Let's see. We'll come back to that one. Uranium as well. URA, and this is a global X uranium ETF. And you've seen just an incredible run in uranium the past couple of weeks here, which is illustrated finally by this chart. And so hitting resistance at the moment in and around the 27.96s. I don't think I'd be buyer here. I'd wait for a wee little pullback, probably into like 22.50s or somewhere like that. Somewhere like somewhere into like say like here 22.80s. Might be a nice little trade there. It's an ETF, so you could get play around with that. Exxon, while I like Exxon, I think it's too high to buy. Essentially, I think we've had a little bit of accumulation going on here through early 2022. We popped to a higher area and just really sideways accumulation through 2023 here. Good dividends here on Exxon. I think we will be trading much higher over the next 2, 3, 4, 5 years for sure. But the safety of the pullback is around $69 here a share. I think if we pull back into there, you see it was that high in 2014 when we kind of just had that peak in fracking production. We had this massive upset in the oil industry. But I think if we came back to anywhere around here, I think it's just Yahoo to the upside, and that's a really nice trade you could be in for many a year. iDrive, I am an owner of iDrive. My son is also an owner of Drive. ETFs for this year, for electronic vehicles, it's a bit dodgy. I don't know. I'd leave it alone, but I'd actually be short this thing. But because I have a very long-term horizon on this thing, I'm just probably going to buy more if we give it up on the 21s, come back towards 15s. I'll just reload the boat there, and I've got a 20-year horizon on this thing essentially. Cars as well. You can see this thing is really kind of just working this kind of downtrend to uptrend. So I don't see cars on a breakout. I think this will be quite contained, and the reason for that is essentially this credit environment. I don't think it's going to lend itself too well to EVs at the moment, and a mass adoption of EVs. I think it needs a year or two more, maybe 25. We'll look at it. All right. So Petrobras as well. Just want to note with people, this is a large component of my personal portfolio. You got a 17.54% TTM dividend. So that's 12 months trailing 12 months. That's what TTM stands for, a dividend of 17.54%. That is way better than the risk-free rate of 12 months at 4.88%, right? So I love it. All right, so that's going to be it for me for the look ahead for 2024. Sorry if I've gone on a bit, but there was a lot to cover. Just kind of, I'll be back looking at the charts in a bit more detail in the first weekly look ahead of the week. I won't be back until Thursday the 4th. So the first weekly look ahead will be what date would that put it at? The Monday the 8th of January. All right, have a good happy New Year's, and I'll talk to you later.